Good afternoon to everybody and welcome to the 7th RISIS Policymakers session dedicated to a valuable study from Politecnico di Milano entitled Democratizing Access to Smart Money in European Union, Evidence from the RISIS VICO-DATASET. Today, as usual, we will have a presentation at the beginning of the Politecnico di Milano, and then in the second part of the meeting, the comment, the observation by our discussant. We are very proud to have with us two high-profile discussants, Helmut, Kraemer-Eis, and Simone Signore from the European Investment Fund. Before giving the floor to Professor Massimiliano Guerini and his team, I would like to remind you some important rules to enjoy the conference. First of all, you must switch off your microphone and use the reactions buttons in the below part of your screen at the end of the illustration. I wish to have a debate at the end of this meeting because the topic today is very, very interesting and is involving the economic framework in the European Union. So, before giving the floor to Professor Massimiliano Guerini, I would like to remind you also our next event, our next RISIS events, that is the 9th RISIS Research Seminar that will take place on 10th of May and will focus on quality as a latent heterogeneity factor in the efficiency of universities with a presentation by Sapienza University of Rome. And then, this is a very fresh news, we will be at the European Forum for Studies of Policies for Research and Innovation at the ESPRI Forum with a sub-plenary focused on the new RISIS dataset, that is easy trademark data collection and exit. Then on July, it's a very full agenda, we will be at the EC conference, International Society for Sensometric and Infometrics, and the next Policymakers session will be after the summer season on 30th of September with a study on cyber by Fraunhofer. So that's all. I would give the floor to Massimiliano Guerini and its team. Enjoy your conference. Thank you so much.
Good afternoon, everybody. From my side, I'm Massimiliano Guerini. I'm a professor at Politecnico di Milano. Now I'm going to share the screen and I'm going to introduce the main topic of this session, that is an overview of the recent evolution of venture capital activity in Europe. Just 1 second. Okay, so hope you can see the presentation. Okay. Okay, so first of all, before starting, I would like to thank again the communication team of the RISIS project, and in particular Alessia Fava and Serena Fabrizio for organizing this event. And of course, I would like to thank our discussants, so Simone Signore and Helmut Kraemer-Eis from the European Investment Fund, for being here. So, as you can see from this title, the topic of this presentation is to discuss whether we observe an increased democratization of venture capital activity in Europe or not. Maybe I already anticipating some of the key findings of this research using the VICO-DATASET, that is one of the core infrastructures of the RISIS project. What are we talking about? Basically, the topic of this presentation is to study the role of venture capital in supporting startups. Startups, especially those that are aimed at developing innovative products and services, are of course an important driver of innovation, job creation, and in general, economic development. And so policies are increasingly oriented towards the support of these kind of firms. The problem with startups, especially innovative startups, is that, of course, they are based on hopefully very good ideas. They have the potential to develop radical new technologies, but at the end, they need substantial financial resources to survive and hopefully to scale up, and so to being able to create economic wealth and, of course, new jobs. When talking about financial resources, one important source of finance for these kind of firms is venture capital. As you might know, with venture capital, we typically intend specialized investment funds that collect capital from a variety of sources, and then they use this money to purchase the equity shares of startups with the aim of obtaining a capital gain in a few years. These investors actually are able to provide significant capital injections to these firms. But besides financial resources, these investors are important because also they can help startups in the growth path by providing also strategic, technical advice, marketing support, enlarging the network of contacts of startups. So the idea is that these investors can be critical in promoting the professionalization of startups and to help startups in creating an organizational structure that is adequate to supporting their growth. So these investors are really important, and of course, given the important role of innovative startups for economic development, supporting innovative startups as well as venture capital firms, or let's say the development of a fruitful venture capital market, has attracted the attention of policymakers, both at the European level and at the national level. So in the last years, I would say in the last decades, actually, we can observe an increasing attention from these policymakers to innovative startups and to the development of a venture capital market from the European Commission, for instance, from people from the European Investment Fund. And of course, here we have with Simone Signore and Helmut Kraemer-Eis, you will see some recent examples of the policy initiatives put in place by the European Investment Fund. Within the Horizon Europe program, of course, there are specific actions that are devoted for the support of breakthrough technologies that are developed by SMEs and startups. And of course, also at the national level, we have a number of policy initiatives like VPI France, or in France, of course, or Invitalia in Italy, that incorporated governmental venture capital funds, or actually providing capital to other private funds for supporting the growth and the scaling up process of these innovative startups. So there is a substantial policy debate on the opportunity of supporting these startups and the venture capital markets because of their importance for economic development. One of the key issues when talking about startups venture capital is related to geography. The point is that the geographical location of venture capital activity is typically highly concentrated in a few preferred locations that are typically called venture capital hubs. And this, of course, creates a big issue for entrepreneurs that are located outside of these locations. And for these firms, for these entrepreneurs, collecting venture capital is much more complicated. And typically, these entrepreneurs are required to move their startup and their operations to these preferred locations in order to increase their chances to get funded. So geography matters in venture capital, and the academic evidence on this topic is really very clear, and show that at the end, the venture capital activity is really concentrated in VC hubs, like, of course, the most famous one is the Silicon Valley, or Boston, or the New York City area in the US. We have the emergence of, in the last years, of new hubs also outside the US. We will provide examples concerning Europe in a few minutes by showing evidence based on the VICO-DATASET. The same is for other areas in Asia, like China, for instance, with Beijing and Shanghai that are emerging as a worldwide hub for venture capital. So with this policy brief, the idea was to provide evidence based on new data that I will present in a few seconds, that is the VICO-DATASET, concerning the geographical distribution of venture capital activity in Europe. And I think that the most interesting part of this policy brief is to show the evolution of this geographical distribution. Here you can find a list of questions that we are trying to address with this policy brief. And in particular, the idea is to see whether venture capital activity is actually concentrated in a few preferred locations, to identify what are these preferred locations, to understand whether there are or whether some venture capital investments in more peripheral areas that are located outside these VC hubs, these preferred locations, and then to observe temporal trends, temporal patterns, so the evolution. So are we observing an increased dispersion of venture capital activity outside the large metropolitan areas? And so are we actually observe an increasing democratization of venture capital, allowing also entrepreneurs that are located outside the large metropolitan areas to get funded from these important investors? Or on the contrary, are we observing an increasing agglomeration of venture capital in these large metropolitan areas? Are there new hubs that are emerging? Are there differences across sectors? So are emerging maybe some specific hubs in some specific industries like the life science or the software, or TLC, and so on? So this is basically the idea of this policy brief, in order to provide a snapshot of what is going on in venture capital in the last year. Concerning data, the main source of information that we are using in order to produce the statistics that I'm going to show you is the RISIS VICO dataset. RISIS VICO is a dataset containing a lot of information concerning venture capital investments, the characteristics of startups that were financed by venture capital investors in the last 20 years, basically, so from 1998 to 2018. For these startups, we have a lot of information concerning the geographical location, for instance, the type of investors that actually finance these startups, as well as accounting information that can be used in order to produce performance measures of these venture capital investments. The coverage is basically the whole Europe. So basically, we cover 27 European countries from the European Union, I mean, plus the United Kingdom and Israel, that is one of the most important venture capital hub in the world. And so this is the reason why we have decided to include also Israel in this data set. For the purpose of this analysis, we decided to focus on the 2010-2018 period, in which we observe around 31,000 venture capital. And now I think we can actually focus on the key results from the statistical analysis that we have performed using the RISIS VICO data. First of all, let's have a look on the overall trend of venture capital investments on venture capital. This in this 10 years period. As you can see from this chart, actually, we observe, in line with other reports that are produced also using different sources on venture capital, an increasing trend of venture capital activity in Europe. These trends have become more stable in the last 3 years, but at the end, the overall trend is increasing. Of course, sorry, I'm just trying to use the annotation, but probably I'm not really used to Zoom. Okay, I'm just trying. Okay. Probably more interesting to look at the geographical distribution on how the different venture capital deals are distributed across the different European countries. Sorry, I was just trying to eliminate this, but I'm not sure I'm able to do it. Okay, here I am. So on these two maps, we can see on the left the number of venture capital deals in the different countries, while on the right, we can see the number of VC deals in the different countries normalized by gross domestic product. If you look at the chart on the left, we can see that, not surprisingly, I would say, the most important venture capital markets in Europe are the UK, first of all, followed by France and Germany. So there is a clear relation between the overall size of the economy and the size of the national venture capital market. Probably it's more interesting to take a look to the right-hand side of this chart, in which we see the emergence in terms of venture capital intensity of some probably new markets, especially in the eastern countries and especially in the Baltic countries like Estonia, Lithuania, and Latvia, that are actually experiencing in the last 10 years an increasing number of venture capital investments in that country. So we might see that, of course, if you look at intensity, even smaller countries in the last 10 years are playing an increasing role in venture capital in the European framework. Now, let's take a look at a more detailed geographical level of analysis. And let's again consider the topic of the geographical dispersion of venture capital deals by exactly identifying the location of these venture capital investments. So as you can see, again, this is in line with the evidence that I reported before. Probably we might observe a greater concentration of venture capital investments in the UK. However, as you can see, while there are, of course, and these are the darkest areas, some preferred locations like London, for instance, here, or Paris, or Madrid in Spain, or Munich in Germany, and so on. So it's pretty evident here by just looking at the overall distribution of venture capital that big cities are actually playing an important role in explaining most of this distribution. However, we observe that even in some more peripheral areas that are located outside these large cities, there is a non-negligible portion of venture capital investment. So this very, very preliminary evidence actually allows us to show that despite large cities actually play a prominent role in terms of venture capital activity, the overall venture capital activity is, however, distributed across locations that are outside these large cities. Okay. On this additional chart, we can see the evolution across different macro regions of venture capital activity from 2010 to 2018. We can understand a very clear pattern. I would say that, of course, in most regions, we observe an increasing trend in venture capital. This increasing trend is particularly evident in UK and Ireland. If we basically compare the overall number of investments made, for instance, in 2010, it was around 700 investments, according to our data source, we observed that basically the number of investments in 2018 is basically 2 times. So it's basically 1,400. So we observe in general an increasing trend in venture capital, but in some locations, and especially in the UK, actually this trend is particularly important. Okay. While looking at these macro regions and also at the country level is hopefully interesting, with this report we have, however, decided to take a closer look and to use a more detailed geographical unit of analysis in order to understand whether venture capital activity is actually concentrated in large metropolitan areas. For these reasons, we have decided to focus our analysis on 3 main types of regions. The first one is large metropolitan areas, so urban areas that with more than 1.5 million inhabitants, and these areas have been defined according to the OECD definition of functional urban areas. Then we have other urban areas that are relevant in terms of population, so basically between 250,000 and 1.5 million inhabitants, and these are, let's say, let's call them metropolitan areas, and in Europe and in Israel, including Israel, we have defined 251 metropolitan areas. And then we have medium-sized, small, and rural areas that are geographical areas that are characterized by a lower population density and less than 250,000 inhabitants. So let's, first of all, using the information on these more than 30,000 VC deals, how these deals are distributed across these 3 types of regions. As you can see, I think that's probably the most interesting number is this one here. 60% of all venture capital deals in our sample is concentrated in these 38 large metropolitan areas that basically account for around 30% of the population of this region. If you look at metropolitan areas, these, so smaller regions, basically these accounts only for 25%, while in terms of populations, actually the weight is similar to the population that is covered by large metropolitan areas, so again around 30%. And if you look at the smaller areas and rural areas, actually, despite they account for another 1/3 of the overall population in Europe, the number of venture capital deals, or to be more precise, the proportion of venture capital deals in this area is much lower. If we make the ratio between these 2 numbers, the venture capital deals and the population, we have this indicator, that is the percentage of VC deals on population, that actually show that that can be used in order to highlight these important concentration of venture capital activity in these large metropolitan areas. Let's now have a closer look on the evolution of the distribution of venture capital activity across these three different areas. So here you can see again let's say the market share, the overall share of venture capital deals across these three areas in three different time periods. It's pretty evident that these concentrations, the importance of large metropolitan areas has increased over time. And from the period 2010-2012 to the period 2016-2018, we observe an increasing concentration of venture capital activity in these large metropolitan areas, while metropolitan areas and small and rural areas are actually observe a decreasing number of venture capital deals. And so this evidence actually is in line with the view that venture capital activity is not actually democratizing, and that entrepreneurs that are located in these medium, small, and rural areas are actually experiencing more issues, probably more troubles, in obtaining venture capital because they are probably located in the wrong location. In this exercise, we have also decided to take a closer look by trying to identify what are the most relevant venture capital hubs. So in this chart, you can find the top 20 VC hubs in terms of the overall number of venture capital investments in startups that are located in these venture capital hubs. And you can see the overall share of venture capital deals in each of these 20 venture capital hubs in two periods. So basically in 2010-2012 and in the more recent period of 2016-2018. So basically, this 17% means that London in the period 2016-2018 accounts for 70% of all venture capital deals occurred in Europe and Israel in this period. This blue point actually is the same percentage, but observed in the period 2010-2012. So this chart actually highlights that London actually is the most relevant venture capital hub in Europe, and actually its relevance, its importance is increasing over time. Then we have, of course, according to the statistics that I showed you a few minutes ago, some other large metropolitan areas that accounts for a significant portion of venture capital activity, like Paris, Tel Aviv, or Berlin. And again, we observe an increasing trend in concentration in these cities. And then we have other cities, some of them are a little bit smaller than London and Paris, for instance, like Milan, for instance, that, however, is observing an increasing trend as well. We have also decided to take a closer look to the industry distribution of these trends. And so we decided to focus on three main industry categories that are software, internet, and TLC, that roughly account for 40% of all venture capital activity in the observed period. The life science, accounting for 10%, and other R&D and engineering services, then again account for 10%. Of course, in VICO, we have also information on other industries, and we have also more disaggregating information, but for the purpose of this report, we have decided to use more aggregated information. On this table, we see the overall distribution of venture capital deals in the different industries, again, in these three region types: large metropolitan areas, and low populated areas, so medium and rural areas. From this table, again, we observe that there are some important differences concerning the distribution of venture capital activity, mainly between the software and internet industries, in which basically more than 60% of investments are actually agglomerated around large metropolitan areas, and let's say more science-oriented industries like the life science and R&D, in which this share is actually much lower. So another key message that we can derive from this analysis is that there are differences according to the industry of operation of the startups receiving venture capital, and that software and internet and TLC startups seems to be much more agglomerated in prominent large metropolitan areas that constitute the most important VC hubs in Europe. If we take the indicator that we have introduced before, so the number of VC deals out of the, the percentage of VC deals in a region out of the percentage of population in the same region, we have an indicator of the increasing concentration of VC activity in large metropolitan areas that is increasing over time. So if we take again the software and internet industry, we observe that, of course, this, as I showed you before, is the most concentrated industry in terms of venture capital deals. However, we observe that this indicator, so the number of VC deals out of the overall population, is increasing over time from the 2010 period to the 2016-2018 period. We observe a similar pattern for the R&D industry. So despite the venture capital investments in R&D are more dispersed with respect to the investments in the software, internet, and TLC, the trend, the temporal pattern, is in line with the view that there is an increasing agglomeration of venture capital activity also for this industry. While conversely, for the life science industry, this trend is not clear, and the figure provided by this indicator is pretty stable across time. Finally, if we put together the information on the key top 20 venture capital hubs with this sectoral classification, we might identify what are the most important VC hubs according to these different industries. If we focus on software and internet, again, London is the key player in Europe with substantial growth from 2010 to 2018. Again, followed by Paris, Berlin, and Tel Aviv, even if, for instance, for Paris and Berlin, we observe actually a decreasing trend. So a reduction in terms of importance of venture capital activity in the software industry, in the internet industry, as compared to other locations. If we look at smaller regions, again, we might observe some emerging hubs, like, for instance, Milan or Budapest or Stockholm here, Tel Aviv that is increasing as well, or, for instance, industries that are located in, cities that are located in Eastern Europe, like Tallinn or Warsaw. If we look at the life science industry, again, London is playing a key role here. However, I think that the most interesting difference with respect to the previous chart is the emergence of smaller regions, like, for instance, Cambridge or Oxford, that actually are characterized by the presence of important universities or R&D centers. And this actually looks not so surprising. So in life science, so in industries that actually relies more on science in order to produce new products and services, proximity with prominent universities and research centers actually is supposed to play a key role. And so we observe an agglomeration that is probably not driven by large cities, but is probably more driven to the production of science and new knowledge. A similar pattern basically emerged also in the other science-oriented industries, so R&D, which still we observe a prominent role played by London and in this case also Paris, while at the end we will see the importance of the same smaller areas like Cambridge, Oxford, and also the rural areas of Oxfordshire. So this chart is basically in line with the evidence presented before. So for more science-oriented industries, again, the proximity with and the agglomeration patterns around prominent university centers play a key role. Okay, to conclude, what are the key findings of this report, of this policy brief? First, venture capital deals are unevenly distributed across countries. UK, France, and Germany, I would add, are of course the most relevant venture capital markets. However, in terms of incidence, so if we relate the venture capital activity to the overall economic activity as measured by gross domestic product, we see an increasing importance of Eastern European countries and Israel. Second key finding of this presentation is that the venture capital activities is actually concentrated, and it is concentrated in big, large metropolitan areas. However, there is a non-negligible share, that is around 40%, of venture capital activity that is concentrated outside these large metropolitan areas. Despite this, if we look at temporal trends, it's pretty clear the increasing concentration of VC in these big cities from the period, from 2010 to 2020. So large cities are playing an increasingly important role in venture capital. However, this is not true for all industries, for all sectors. The evidence provided here, for instance, highlights that for some industries, specifically for those that highly depend on science and knowledge production, there are other patterns that actually explain the geographical distribution of venture capital. What are the key policy implications in our opinion? And probably these are some hopefully interesting starting points for a discussion also with the discussion and with the people that is connected here. Point number one. In the last years, there is an increasing debate in policy circle as well as in the academia concerning the democratization of finance, in particular, the democratization of equity finance for startups and for entrepreneurial ventures more in general. In the last years, we have observed the emergence of new alternative channels like equity crowdfunding, reward-based crowdfunding, or peer-to-peer lending that actually allows several entrepreneurs that are, yep.
Tev pašu gaidu uz Kumpalām braukt. Bet nenokavēsiet?
Okay, I think that.
Es domāju, nenokavēs Kumpalas.
If you can please switch your microphone to the off mode. Thanks. Okay. I was just saying that I'm almost done. Anyway, so there is the emergence of alternative financing channels that can actually represent a good opportunity for entrepreneurial venture, even if these are located outside large metropolitan regions. However, this increasing trend is not reflected in the venture capital industry, according to the evidence provided here. and especially if we look at well-developed venture capital markets like the UK, it seems that this democratization path did not involve venture capital. And so, of course, from a policy perspective, this is an important issue in order to allow entrepreneurs that are located outside the large metropolitan areas to find mechanisms, policy initiatives that can actually help these entrepreneurs in finding additional financing sources that can be critical for sustaining the growth of the entrepreneurial project. Another important policy issue that is related to this report is associated to the role of governmental venture capital initiatives, and more in general to the role of governmental intervention in the VC market in closing regional gaps. For instance, in France, we observed a more dispersed pattern of venture capital investments compared to other countries, for instance. And at the same time, in the last years, France was very active in terms of governmental venture capital initiatives in trying to support entrepreneurs that were located outside big metropolitan areas. So, of course, probably we would need to go more in depth with studying this issue, but this very preliminary evidence seems to support the view that governmental venture capital initiatives can play an important role in closing these gaps that are associated to the geographical location of entrepreneurs and startups. Finally, according to the evidence that we have shown concerning more science-oriented sectors, policies that are aimed at increasing the regional knowledge capacity of regions, so the production of new knowledge of science, reinforcing funding to universities and research centers, can play an important role in creating new, emerging startup apps that at the end are even able to attract venture capital investment. And so the example of Cambridge and Oxford in the life science seems to suggest that at the end, promoting knowledge creation in specific locations, despite their overall size, can be a good way to change this increasing agglomeration and concentration pattern across large metropolitan areas. Okay, I hope I think I was on time. So I would like to thank you all for the attention. And now I'm leaving the floor to Simone Signore for the discussion. Thanks a lot.
Thank you so much, Professor Guerini, for the illustration. And you can stop sharing the screen. Perfect. And we welcome Simone Signore. Okay. So the floor is yours.
Okay. Thanks a lot, Massimiliano. This is Helmut Kraemer-Eis here speaking. Just give a short introduction before Simone comes to the focus. So in general, many thanks to the organizers and the research team for having us here today. It's a real pleasure for us to contribute to the discussion here today. So I try to move the slides. It works. Yes. So Simone and I, we are both from the research team of EIF, so from the research side, not from the transaction side. And we are kind of split personalities. So we are a combination of researchers and practitioners. So I mentioned this in order to put our contribution and intervention into perspective. And we'll also split our intervention here today. And as not everyone in the audience knows us and knows EIF, I'll put our activities and also the research activities into perspective. And this will just take a few minutes But this will show that the topics like the access to smart money, related agglomeration patterns, the geographical distribution of venture capital and funding patterns, so the key aspects of the policy brief, they are very close to our heart and also part of our own day-to-day research activities. Therefore, for us, it is indeed very interesting and relevant to be part of this session here today. And the discussion of the paper itself, so the focus of our intervention today, will then be done by my colleague Simone. He is senior researcher in my team and the key person for our impact assessment activities. So let me first say a few words about EIF and our research activities in the venture capital space. That was the wrong direction. Okay, so we are an EU body dedicated to improving access to finance for small businesses. We do not invest or lend directly, and we are not a bank. So we use financial instruments to address gaps, foster sustainability, multiply resources, and in doing so, we improve access to finance for SMEs in particular. We work via financial intermediaries, providing, for example, equity to venture capital funds or guarantees to banks or guarantee schemes. And important here is really our intermediated model. We act jointly with market players, not against them. It's a crowding in approach, and therefore to analyze market developments and market needs is key for us. Our shareholders are the EIB as main shareholder with almost 70% of the shares, and together we form the so-called EIB group. But also the European Union, represented by the European Commission, is a very important shareholder with around 21%. And not only as shareholder, the Commission is very important, but also as mandator. We are implementing partner, and many of our activities are backed by the European Commission. In addition, we saw it here as well, we have an important group of public and private, but mainly public financial institutions as shareholders. So we are a kind of public-private partnership. Our products help small businesses at every stage of development, and the ambition is to intervene whenever there is an identified market gap. Therefore, again, we have to analyze these markets. We offer products from the very early stages, like technology transfer, business angel financing, and the like, to the matured companies, guarantees, securitization, hybrid, debt equity, and everything in between, like the mid-market, products specifically targeting impact investing or products related to inclusive financing, and of course, the entire range of venture capital financing. So the focus of the session today here. As mentioned, these activities require the analysis of the respective markets, and this is the task of my team. We are a specialist for applied research, for market analysis and economic impact assessment. We are advisor focused on SME financing and covering the whole range of EIF's activities, the existing activities, but also potential future activities. And we are a key element of EIF's strategic development, and we are part of various research networks and like to cooperate a lot with the academia and academic researchers. And we contribute to external positioning of EIF. The main pillars of our research activities are market analysis and the generation and provision of market information, impact assessment, as I mentioned already, publicity and research cooperation, also mentioned already. And the topics of today's discussion are related, of course, to the market analysis part of our work, but in particular as well to impact assessment, the analysis of the effects of our interventions. As a policy-driven institution, this is a high priority area for us. And we started this data-driven quantitative research stream in 2015 and had a series of studies since then. Main examples on the guarantee side are counterfactual studies related to different regions, different countries, and a pan-European assessment. And parts of this work were done in close and great cooperation with Massimo Colombo's team and network, and also in cooperation and on behalf of the European Commission. On the venture capital side, we have as well a series of studies. We looked so far at the development of the venture capital ecosystem from our perspective. You will see elements of this a bit later. We looked at financial growth and cluster analysis of investee companies. We looked at liquidity events and at EIF-supported innovation and patenting activities of the beneficiary companies. In 2019, we performed the first counterfactual analysis, a very, very tricky exercise, and published an innovative study about what we call the VC factor as cooperation with Invest Europe, the European VC Association, analyzing the impact of venture capital on investee companies in Europe. So not only looking at EIF's activities, but at the impact of venture capital in general. Insights also for us, and also insights that feeds then into our operational activities. In February this year, we published the 6th volume of our series and looked at exit and innovation outcomes. We also geolocated the capital flows of our venture business, and Simone will talk in more detail about it in a minute. You can get an impression by this smart animation here that's running in parallel. And our activities have a high relevance for the VC market. Just as examples, in the period 2007 to 2018, about 1 of every 12 euros invested in European startups were provided by, respectively, via the EIF. Due to the intermediated model, this translated to up to 40% of venture deals in the EU and UK being supported by EIF. Of course, this provokes the question, what is impact? However, it is also important not only to ask about the if of public support, but also about the how. So also an important and relevant question for us as researchers working at the EIF. We performed as well a couple of counterfactual analysis. I won't go here into the details in the interest of time. So we looked at the economic growth of the beneficiary companies. We looked at the exit environment, also a counterfactual study. And we looked in general at the VC ecosystem and how the ecosystem developed, also based on our support. And as I mentioned, this is in particular based then on the geolocation of our venture capital activities and the venture capital flows from the funds to the investee companies. And with this rather long introduction, I wanted to set the scene and to make the link between researchers and practitioners, and as well between the discussion of the topic here today and our own perspectives. I still want to mention that these research papers that I mentioned are publicly available. They have been published. You can find them on our website. And now, without further ado, over to Simone and the discussion of the paper.
Thank you very much, Helmut. Can you hear me?
Yes.
I hope you can. Very good. Thank you for the introduction, but also I would like to say thank you to Massimiliano for the presentation, and of course for the work. It was a very, very interesting and pleasing read, the policy brief. Really quite enjoyed it. I would the topic of my intervention today and right now is to discuss a few points that kind of came up to my mind also based on the research that we are doing at the EIF, and perhaps this could be further food for thought for the discussion for the debate that will be coming into the next phase. So essentially, before I jump into my points, I would like to, as usual in the case of a discussion, give a quick outline of the paper, just to give my highlights of it. And it's a very simple research question by itself. I mean, are there agglomeration patterns in the venture capital-backed industry? Of course, we have seen the results, and we have seen that such agglomeration patterns exist. But the question of how and why this is happening, it's a little bit less trivial than it seems. So in terms of research, this paper is quite useful in also in policy implication, in that it uses information from the innovative RISIS VICO-DATASET. I say innovative not just because it's a very specific and special data set, but it's also because it has been recently renovated. I think it's been actually around for quite some time, and I remember starting working on this subject, and the VICO dataset still was and is a reference in that sense for venture capital in Europe. And it also looks specifically at the geographical distribution, but also including the sectoral dimension. Obviously, in terms of findings, we see that there is an uneven distribution of venture capital investments, particularly focusing on large metropolitan areas, which represent the lion's share of the venture capital activity. But also more interesting, I would say, there seems to be an increasing concentration of venture capital activity in the aggregate, and we've seen that this is particularly driven by a few industries more than others, which is also one important point of this policy brief. I would like to then jump on a few discussion points, which I would like to further elaborate. And one of the points that I would start with is this idea of that the policy brief focuses specifically on, or particularly I would say, on the so-called demand side of venture capital, namely the startups. But there is some interesting thoughts to be given also on the supply side, which I would like to also share based on our studies. A second point that I would like to raise is the idea of the policy implication and what it means for regional policy or for a policymaker, that there is an increasing concentration, or let's say an increasing loss of dispersion, let's put it this way, in terms of the venture capital activity. I have the feeling that the policy brief, but also the accompanying paper, which I've also quite enjoyed, talks specifically about what I would call the stick of more concentrated venture capital. So essentially making it a sort of a regional policy or regional convergence issue, that some areas are losing a little bit attractiveness in terms of venture capital. And I would like to give a little bit also the carrot of this, meaning that there is value, and we do see value in some analysis about why it is useful to have a more diverse and dispersed venture capital industry. I would like to conclude with, I would say, perhaps a minor point, but it's still a policy relevant and also data relevant and scientifically relevant issue about the analysis of venture capital and the venture capital industry, and it is the quality of the data. And I would like to give an example that we found quite illustrative of these challenges. Let me start with the first point on the agglomeration patterns. What you see here is based on one of our research studies, namely one of the first papers we published in the topic in 2016. And let me just say that all the information that I will discuss is mostly based on the EIF portfolio, which doesn't necessarily mean that it is a representative picture of the European venture capital ecosystem. In this particular case, however, we are backing this up also not only through the analysis of Massimiliano and the other, because in a sense they kind of coincide, or they are really quite similar, but also in the fact that we have performed, as Helmut said before, some research also with Invest Europe, which allowed us to give a kind of a wider look at the overall European venture capital ecosystem. And so in this particular analysis, what you see here is the top 20 hubs by venture capital investments received over a time period of almost 20 years from 1996 until 2015. And essentially, these hubs, they're obviously not just the location of the companies or the headquarters of the companies, but it can also be the location of the investors. And in fact, a point that I would like to mention is that on the demand side, we clearly see that there is agglomeration of startups, but in fact, also on the supply side, for many reasons that are to a certain extent obvious and sometimes less obvious. Also, the venture capital, the VC firms, the investors are themselves quite agglomerated in these large areas. And of course, one caveat about this point is that a venture capital investor and firm can have multiple offices. And in fact, we do see that the more established and experienced VC firms, they do tend to open up offices in various parts of Europe. And this actually, we consider it a kind of a positive development in that sense. But it does tell a story that also on the supply side, the distribution of investors is quite uneven. And if you couple this finding with the fact that the venture capital investing model itself is an approach that is a function of the distance between the investor and the company, then I think we have a pretty insightful picture as to why the fact that we have quite, let's say, agglomerated set of investors in certain areas leads to mostly agglomerated pattern in terms of investees. Now, to be clear, it's important to also know that investors do not just look at the specific hubs, but in our portfolio, let's say, hub and hub-placed investors, they also looked outside of the hub. In particular, 63% of investment volumes, they went outside of the hub, but within national borders. And in fact, almost 40% went cross-border, which is quite an interesting finding, and perhaps can offer a little bit of a glimpse of policy implications there. And the point there is that there might be ways to address the shortage or the potential shortage of venture capital financing in more peripheral areas by promoting, as it is one of the EF's goal, for instance, more cross-border activity. That means investors that go beyond the national borders to find investment opportunities. But of course, as I said before, the venture capital market also works as a function of distance, because distance can also imply several things in terms of monitoring capability or also search cost in the first place. And that is why it might be important to have a specific focus on promoting cross-border activity, or perhaps as an alternative policy idea, one could think of syndication networks with between, let's say, more experienced investors located in some of the large hubs, with also locally experienced investors on the side of the more, let's say, smaller areas. What is also certainly interesting is that the venture capital market, as a function of distance, also necessitates trust and necessitates the right legal and institutional infrastructure, and that is also an important point that needs to be considered when promoting a larger outreach towards less, let's say, developed areas when it comes to supporting venture capital financing. So in terms of the second point, I mentioned before that I would like to give a little bit the carrot as to why one should look at regional convergence in the UVC ecosystem in terms of, let's say, a desirable achievement and a desirable objective. And one thing that we try to do in this context is to look at again, at the EIF's portfolio and look at companies supported by the EIF and look at how they grew over time following a venture capital backed investment. So essentially, and there are many other profiles that emerged from this analysis, but essentially what we noticed is that there were two broad type of outperformers, and one type of outperformer that would prominently grow in terms of sales, increasing the revenues in quite large extent. I'm talking about, for instance, 400%, 500% year-on-year growth. Over a time period of say about 5 years. And there was also another group of outperformers which prominently grew in terms of patenting and or innovation. In this case, in this study, we used patents, which are not a perfect approximation of innovation, but also using intangibles and other variables, which all have their caveats. Of course, we would get similar picture in terms of the differentiating, let's say, patterns of this growth profiles. So what was interesting from us from a geographical perspective was that there is a clear distinction, as you can see here in the map, in some areas where companies tend to grow prominent specifically, but not exclusively, but of course they tend to grow on average more in terms of sales or in terms of patents. And of course, it's obvious to kind of pinpoint this to country or national differences or national, let's say, indeed, national institutional settings. But I would also like to point out that if you look closely into each country, into almost every in each country, you can find an area where, or let's say a hub, where there is essentially, let's say, an area where it is different, it is divergent from the average of the nation. I'm thinking, for instance, in Germany, it's clearly that there is an area also that is focusing on patent-based growth, and also in the UK, which is largely focused on patent-based performance. We also have some spots of sale-based growers. And we do not go too much, in fact, into the details of this in the study, but what we consider this to be a reflection of is perhaps some sort of biodiversity of the European VC ecosystem, which can be, of course, linked to regional, national, subnational institutional setups, industrial framework, and so on and so forth. And we think that this is a healthy biodiversity to sustain in the ecosystem in order to have different types of different typologies of companies and different growths. And we think that this could also make the overall ecosystem a bit more resilient, perhaps during, as we've seen in the past years during the COVID-19 pandemic. The last point that I would like to mention is the cautionary tale about the dealing with data in the venture capital industry. Last year, around this time, of course, we were all almost kind of shocked and a bit lost to find ourselves in a new working arrangement in almost a new world. And also, we assumed that this would also have impacted the venture capital market. So we asked a simple question: how is the venture capital industry reacting in the wake of COVID-19, and in particular of confinement measures? We looked at different data providers, and what you see here is a chart of the two, let's say, main stages of equity financing. You have venture capital and private equity. But more importantly, you have 5 different providers and a reference trend from Invest Europe based on the global financial crisis of 2007, 2009. What is interesting here, and let me just say before I say what is interesting actually, is that this is an indexed growth. This is not even based on the levels, which will be completely diverging from one provider to the other, which to a certain extent it's fine. But even the direction in the first few quarters of 2020 was not clear, especially in the context of venture capital. So according to some providers, venture capital was actually growing. In some others, it was actually suffering quite significantly. It was only after a few quarters that the situation sort of stabilized a little bit, and now we can more or less see that the VC industry was in fact more resilient than we expected it to be if we look at, for instance, the global financial crisis. The picture is still quite blurry, I must say, when it comes to private equity. But the point, and I do not want to extrapolate too much about this from this, but the main point about this this finding is that it might be that data sources or some biases in data source may be the cause of some of the patterns. There, 60% of startups located in large metropolitan areas. It might also be a reflection to the fact that there is underreporting in less peripheral areas, which is actually based on some other studies, on some other data sources that we see, including and not specifically Invest Europe. The picture does seem to point out that this difference is a little bit more subdued. It still is a fact that the large lion's share of the investment goes to large metropolitan areas, but perhaps the actual magnitude of this might be a little bit more contained to the fact that less investments are reported in the more peripheral areas as well. This said, I very much, this is not really, let's say, a critique to the fact that there is this increasing concentration. This is very much still there as a phenomenon, and it will be very interesting to discuss this also in the next discussion. Overall, this was a very timely and I would say policy relevant analysis about the agglomeration patterns of venture capital activity in Europe, UK, and Israel. And of course, the data set is a very, very rich and valuable resource, and it's very insightful in terms of policy analysis. And of course, the findings themselves were quite compelling and quite clearly explained and quite insightful. As Helmut mentioned, one of the policy implications of the report is about whether government support might, to a certain extent, offset what is this kind of inevitable trend towards more concentration, especially in the ICT industry of startups. And the question is, of course, that perhaps the government intervention can, but it's also important to mention once more that it's also about the how such government intervention can affect and how it should affect the venture capital industry. Thank you.
Thank you so much. Thank you so much, Simone Signore and Helmut Kraemer-Eis from EIF. I would invite the audience to the open discussion. So I would give the floor to the audience. I remind you that you can use also the reactions buttons and address your question to the presenter or to the discussant that have illustrated the policy implication and the. Okay, I see. Any reaction from the floor? I listen. Okay. Massimiliano, Professor Guerini.
Yeah, just a quick reaction.
Okay.
First of all, I would like to thank Helmut Kraemer-Eis and Simone Signore for their very, very nice discussion. And I want just to say that I actually agree on the main points that have been raised. Just a few maybe comments on this point. Concerning the point number one on the supply side, I totally agree that, of course, also in order to derive some policy initiatives, it is important to look at the supply side. And I agree that probably as policy implication, trying to stimulate international syndications between investors, especially more experienced investors from prominent markets like the UK, for instance, investing in smaller regions, in less important markets, can be a way probably to stimulate the emergence of venture capital industry in smaller regions. I have a study ongoing on this topic in which actually we showed that through syndication, actually less experienced investors can learn from more experienced investors, and so the performance they are able to achieve in subsequent investments, even without these experienced international investors, is actually higher. So there is some kind of evidence that, of course, these kind of interaction can be actually useful for less experienced investors to learn how to do the job basically in a much better way. So I totally agree that probably the focus on international investments and syndication can actually be a promising avenue for policy initiatives. I also found very interesting the map that you have shown concerning the biodiversity of the European landscape. And I see that, of course, there are some within country differences, but what actually impressed me very much is this, kind of country level specialization towards innovation or towards more revenue growth that actually is probably worth investigating. And concerning the data, of course, I agree that, and I know that, of course, there are a lot of heterogeneity in the different data sources. Just to advertise a little bit our effort with VICO, actually, what we have tried to do is to combine these different data sources and to put them together to verify what is the relative coverage of a specific data source to the other one, in order, at least as far as we can do, to overcome these issues. That, of course, is an issue, especially if you look at more recent data. I totally understand that. Of course, if you want to evaluate the impact of COVID, probably there are some sources that are more updated than others. This is my feeling. Thanks again.
Okay, thank you so much, Professor Guerini. There is an intervention now from Professor Colombo, please.
Yes, well, I would like again to thank Helmut and Simone for these very complimentary and very insightful comments to our presentation. Thank you very much. And their comments stimulated my brain, and so I will bring a question to both Professor Guerini, Helmut, Simone, and all the floor. And but before, I would like to emphasize one point about the quality of the data. Our impression is, as Massimiliano mentioned, well, we did a big effort historically to bring together different sources and clean them up, right? With the idea that each source has its own bias, and so bringing them together, the bias, we can average the bias, right? Well, the impression we have is that the coverage of these sources has increased over time, and these make even more worrisome the trend towards increasing agglomeration in a few large metropolitan areas, right? Because with better coverage, we may have, it was a bit of a surprise, right? Because one may think that the deals in peripheral areas which were uncovered before with better coverage, well, they were more present. And in spite of that, we see a big agglomeration, right? Then, of course, there are differences across sector, there are different across country, etc., etc. But still was a big surprise. And then my two comments. The first one is a general comment. Why geography matter? Because at the end of the day, one could say, well, what's the problem that venture capital is in London and in Paris? If you start a company in, let's say, Ancona on the seaside, well, you take your flight, you go to Paris or to London. What's the problem? And the problem is that people do not move, at least in Europe. We have a working paper underway where we try to study it's not easy to do that, to study the movement of startup from the day one up to the day where they get venture capital or even later on. And it seems that the pattern of relocation is completely different from the United States. And more, well, the feeling we have, we do not have still robust results on that, but the feeling is that venture capital is maybe an add-on in the relocation decision, but it's not the key driver, right? And that, of course, makes geography a big issue. And the second comment on this is that we published the work in last year where we checked the demand, right? The demand for venture capital, not the equilibrium, because what we observe in this data is the entrepreneur who are able to get venture capital, right? And instead we asked entrepreneur, whether they were searching for venture capital or not. And the key evidence from this study is that if you are located more than 250 kilometers from a hub, the density of venture capital in a hub does not have any influence, right? So if you are close, the closer you are to a VC hub, the better it is in terms of probability that you are making effort to get venture capital. But if you are, let's say, farther than 250 kilometers, probably you say, oh, there is no way. I'm not an interesting target, so better that I forget about venture capital, right? That's the second reason why geography is very important. And then my last comment is here we focus on access. So basically, it's a binary variable, right? Either you get venture capital or you do not. And I think another interesting point is at what condition, right? How you get it. And curiously enough, study about valuation and how geography influences valuation. And valuation is a very key aspect, especially at the seed stage, because the higher, the lower the valuation, the more the equity that you have to give to invest or to attract them, and this of course is an issue, and which can discourage entrepreneurs. And so I think it's an interesting aspect that we intend to study in the future is how it's a geography of valuation, and whether agglomeration means more competition and so better deals or not, right? Okay, I will stop here my comment. Thank you.
Thank you so much, Professor Colombo, for having illustrated this key aspect on geography and access. Now I will give the floor to Philippe Laredo, our project coordinator, who raised his hand. Welcome, Philippe.
Hello to all. I wanted to ask two questions. The first one is, you've said that the new forms of finance, which you call democratization of VC finance, do not seem to play any role. But could there be a connection between the distance from the big hubs and the ability and the role of these types or new types of VC funding? Especially, you could link it with what you say about the fact that in university centers, that the VC activity might play a role, but it's far more dispersed, so it's less important sums of money per deal. So what is your views about these type of evolutions or possible evolutions?
The question is addressed to Simone, Signore, and Helmut, Kraemer-Eis.
Okay, maybe repeat it. Provide a first reaction from my side. What we are observing in terms of the evolution of the entrepreneurial landscape is, as I was mentioned during the presentation, the emergence of these new channels, mostly web-based channels that actually are helping entrepreneurs in collecting capital, especially in the very, very seed stage, let's say through equity crowdfunding, for instance. It's a kind of different capital with respect to venture capital, of course, because with crowdfunding, you might actually collect small money that can actually help you in starting a business, in incorporating a business, maybe in developing a very basic prototype, also depending on the complexity of the underlying technology. Of course, there might be some complementarities. That means we are also studying, for instance, in Italy, the complementarities between equity crowdfunding and VC, trying to understand whether firms that actually were successful in running a equity crowdfunding campaign, then they were actually able to get VC, for instance. The evidence is not very clear. The point is that it seems that these are, for the moment at least, two different markets with very limited overlap. So, and the reason, I mean, it's, let me say, straightforward in my opinion. Of course, if you want to sell your idea to the general public, I mean, you have to present something that can convince the general public, people, and people must be reassured about this idea. And so, I mean, the complexity of this idea, the technological content, I mean, is somewhat limited. And also the time to market should be limited. If you are talking about, I don't know, a biotech startup trying to develop the new vaccine for COVID, of course, you cannot use equity for funding, that's the point. And of course, for more radical, complex based startups that rely on science, like the life science industry, I mean, the role of venture capital, and I would also say the role of policy initiatives is substantial. If you think about, I don't know, the biotech story with the COVID vaccine, I mean, they got a lot of money from the federal German government. So it's, I mean, it's a different market. So looking at, just to sum up, the emergence of these alternative channels is of course important to sustain entrepreneurship. Not all types of entrepreneurship, and still the issue of stimulating high growth oriented entrepreneurship, startup activity, and scale up activities outside the large metropolitan areas and large VC hubs is still an issue. And so, I mean, some specific policies that are more focused on venture capital are probably needed in order to stimulate democratization of these venture capital. That's my view.
Yeah, if I can add again a couple of comments, Philippe, I think it's an issue, it's an important issue, and we do not know enough, right? There are a lot of work around the world which pose this question, right? And what we wanted to stress in the policy brief is that the idea that the seed market is now full of channels and everybody, and it's like going to the supermarket when if you want biscuit and you do not find biscuit, you can get jam or something else, and so you go home with something. Well, this is a very naive idea, right? And so it's an issue that needs to be studied in a rigorous way, and without naive assumption that the new channels solve the problem, and so startups do not need do not have any serious challenge now at the seed stage. That's my personal opinion about that. And of course, the sequence is more complex, because just to add another piece of evidence, the naive idea is that you get first alternative channel and then venture capital. And in fact, when you, just to give you an idea, when you focus on Kickstarter and you focus on the largest campaign, getting at least 100,000 or more, 30% of this campaign are launched by companies which already have venture capital or so professional investor on board, right? So the sequence may be reverted in this case. So I think we need more work in this area.
Helmut here. Maybe I can quickly add to this as well, and I fully agree to what has been said by Massimo and Massimiliano. So in Europe, these alternative channels, they are increasing further. Not everywhere around the world, they are still increasing, but they cannot replace the traditional channels, and I as well think they should not replace. They are nice complements to this financing landscape, but you have plenty of issues, like in particular asymmetric information issues that are still not solved. And what we see in the market is that, be it on the debt side or be it on the equity side, in this trend to the platformification, as we call it sometimes, there is also in parallel a clear trend to institutionalization, so that institutional investors, experienced investors, they are using these platforms as well as distribution channels for their products, be it for venture capital or be it on the debt side. So this is clearly happening. But I don't think that we will see a trend that venture capital investing, which is quite complex investing and knowledge intensive investing, will be at some point a type of retail investment. I don't see this coming. And then a second quick comment is that indeed the aspect of geography or distance to investment is quite complex. We once performed an assessment on the business angel side and looked at the drivers or the determinants of distance in the investment decisions, or the distance between the investor and investee, and we realized there are many different drivers, and the same counts for the venture capital side and is valid for the venture capital side. But maybe we will see as well changes now driven also by the pandemic, because investors and investees were forced to find new ways to performing due diligence, to presenting themselves from the company perspective. And maybe this has in the long run as well an effect on agglomeration and geography of financing. Thank you.
Thank you so much, Helmut. There are any reaction from the floor? Any other reaction? I hope this meeting provides you exciting content, starting point to discuss and to explore in this new framework we are living. And if you wish to read RISIS policy brief, I can write the link in the chat. We produced, the consortium produced so far 7 policy briefs. The last is from POLIMI. I thank you. So the time, we have time for any other reaction from the floor, if you wish.
I mean, if there is nobody else, I would have an additional point, Helmut, again here.
Okay, thank you, Helmut.
We saw clearly that venture capital hubs are playing a very important role. But we saw as well that the ranking of these hubs that changes quite significantly over time. So it would be an interesting research question to analyze the reasons or the drivers for these changes in rankings. Of course, we see emerging hubs, but it would also be interesting to look at the declining hubs. What are the reasons for the decline? The reasons in general for hubs and hub creation can be very diverse. And we saw that Oxford, Cambridge, these are important hubs. This is clearly driven by the existence of the respective universities there. We saw London as the outlier, but also the European financial center, which drives then the existence as VC hub as well. Berlin is one of the hubs, but there the reasons are most likely very different. This was driven by the German reunification, and at the time Berlin was a cheap city, and plenty of young people came to the city, plenty of young entrepreneurs and also capital providers came to the city, and this contributed to the fact that Berlin emerged as venture capital hubs. And so there are many different reasons for different hubs, and it would be really interesting to perform further research on the causalities for these developments. Thank you.
Okay, thank you so much for this comment, this observation about the different aspects that can contribute to the venture capital concentration. I thank you, every participant.
May I add another comment?
Yes, sure.
Well,
You're
I think that
very welcome.
In the debate we mentioned the shock of the pandemic, who may have changed how investors see distance, right? Because they were forced to do their job at distance, right? But we have to keep in mind that, and we have another shock, is Brexit, right? And when I saw the data about and the trend of the Helmut correctly say that we have an outlier, which is London. Well, we do not have any longer, right? So that means that 20% of the venture capital deals, so the startup financed by venture capital in Europe, right, now are outside Europe, right? So I think that would be extremely interesting to see how Brexit affects the geography and more generally the functioning of the European venture capital industry.
Thank
you so much. We collected the suggestion for a new work, for a new policy brief from now, Massimiliano.
Yeah, no, if I can just add more in general, I think the analysis of the determinants concerning the emergence of new apps, but also of the decline of maybe more established apps in some specific industries. It's really an interesting and challenging research questions, because of course it's isolating all causalities, causal relation between what have been caused the change, and of course the effort is challenging from an empirical point of view. But I totally agree that is an interesting piece of research that can then also provide some useful policy implications. So thanks for this suggestion.
Okay, so I have a sentence from Xuan Yang to everyone. Yes, I'm also interested in Brexit effects. Thanks. So now we must go on on this. I thank you. In particolare Politecnico di Milano, Professor Guerini, Professor Colombo, and Francesca Enrica Tenca, and in particular our higher profile discussant, Simone Signore and Helmut Kraemer-Eis from European Investment Fund, for contributing to this very interesting and valuable discussion. I wish you a pleasant afternoon, and I remind you our next events. You can go on our website, RISIS2.eu, and on our social channel to be informed about our next activities. Thank you so much again to everybody, and bye-bye. Thank you.
Thanks.
Thank you.
Thank you.
Many thanks.
Bye to all.
Bye-bye.
Thank you for participating.
Thank you.
Bye.
Bye.
Thank you. Bye-bye.
Thank you. Bye-bye.
Thank you.